Good morning, ladies and gentlemen, and a very warm welcome to the IIM-Kozhikode-NSE second annual conference on macroeconomics, banking, and finance. It is an honor to stand before you today as we embark on a day filled with thought-provoking discussions, insightful deliberations, and meaningful networking. To mark the beginning of this significant event, let us all rise for the Indian national anthem.
अधिनायक जय हे भारत भाग्य विधाता पंजाब सिंध गुजरात मराठा द्राविड उत्कल बंगा विंध्य हिमाचल यमुना गंगा उच्चल जलधि तरंगा तव शुभ नामे जागे तव शुभ आशीष मागे गाहे तव जय गाथा जन गण मंगलदायक जय हे भारत भाग्य विधाता जय हे जय हे जय हे जय 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 हे.
Thank you. To formally inaugurate the conference, we will now proceed with the traditional lamp lighting ceremony symbolizing knowledge, wisdom, and prosperity. I would like to invite our esteemed speakers of the inaugural session, Sri M. Rajeshwar Rao, Professor Debashis Chatterjee, and Sriram Krishnan to please light the lamp. I would also like to invite Professor Mridul Sagar and Dr. Dithankar Patnaik, who are the ideators of this conference, to please come on the stage. Sir, I would also, Sir, MD Sir, could we have you on the stage also, please? With the conference now officially inaugurated, I would request Professor Mridul Sagar to give a brief introduction about the conference and Uruppika.
Well, maybe I'll just take a minute So the idea of the conference is extremely important. I mean, we all know economic growth depends on ideas, and Paul Romer got a Nobel Prize essentially on that count, that it's the ideas which derive the long-run economic growth. The idea of Uruppika, the Center for Macroeconomics, Banking and Finance at the Indian Institute of Management, Kozhikode, came actually from Professor Debashis Chatterjee sitting here. And he asked me that can we set up a center, and we did set up with my colleagues sitting here, Arvind, Rudro, Abhilash, and Ashok. So there were a few others who are not here. And we named it after Uruppika, which was the early coins of Samudri Kingdom, which preceded the Indian rupee. So this conference idea came essentially when I was sitting with Tirthankar Patnaik here, and we said we want to host a conference, and he said, let's do it together. And we decided to do it together. Last time I spoke to Anant Nageshwaran, Kamath, and Dinesh Khara, all of who readily agreed that they will come and speak at this conference, and that's why this level of conference has been set high after the first conference. The conference this time, the idea sprang in London over a cup of tea with basically leading French economist who is a co-author of Esimologu, who is a Nobel laureate last year. And he sort of said his research is telling that the total factor productivity growth out of the disruptions we are going to see on digital technology would be 0.71% a year. And his co-author said it will be he said over a 10-year period, and his co-author said 0.68% over a year. So the diametrically 10 times difference was there over what this technology will do to growth. And imminently, I thought we should learn more about it, and we should do this conference on this theme. And that's how we're here today, and we will have a talk really around this time. So over to you, and maybe we'll request.
Thank you, sir. May I request Sriram Krishnan, Chief Business Development Officer of NSE, to extend a warm welcome to our distinguished speakers and the participants with a few remarks.
Respected Shri M. Rajeshwar Rao, Deputy Governor RBI, Shri Debashis Chatterjee, Director IIMK-NSE, Shri Ashish Chauhan, our MD and CEO, Shri Mridul Sagar, Professor of Economics, IIMK-NSE, Shri Debadat Chand, MD and CEO, Bank of Baroda, Shri Rajneesh Karnatak, MD and CEO, Bank of India, distinguished faculty members, other dignitaries, esteemed speakers, ladies and gentlemen. It is with immense pleasure that I extend a warm welcome to each of you to the IIMK-NSE second annual conference on macroeconomics, banking and finance. It is an honor to host such a distinguished gathering here at NSE, and I'd like to express our heartfelt gratitude to IIM-Kozhikode for collaborating with NSE on this important event. This year, our theme, Finance for Growth Amid Creative Disruptions, couldn't be more timely. As the global economy continues to evolve, the importance of understanding how finance can drive growth amidst disruptive forces, whether technological, economical, or social, becomes increasingly paramount. This conference promises to offer insightful discussions on how our financial systems can adapt, evolve, and remain resilient in the face of changes. India's economic journey is an inspiring one. From being the 10th largest economy in 2014, India today is the sixth largest economy of the world with a GDP of 324 lakh crore rupees. India is projected to become the third largest economy by 2027. The country's growth has been significantly supported by its capital markets, which have experienced remarkable expansion. India's equity market, with a market capitalization of rupees 444 lakh crores or USD 5.1 trillion as of 31st December 2024, is the fourth largest globally after US, China, including Hong Kong, and Japan. The market is also unique, with no other country in the per capita income range of $2,500 to $20,000, matching India's market size. In fact, India's equity market capitalization has outgrown the banking sector. Today, it is 1.7 times the size of the banking sector. NSE has been privileged to play a pivotal role in this growth story. In 2024, we helped raise a record 1.7 lakh crores through 268 IPOs, making us the highest globally in the IPO fundraising. Overall, NSE helped companies raise a total of 17.9 lakh crore rupees through equity and debt in 2024, a 32% year-on-year increase, outpacing bank credit offtake of rupees 7.7 lakh crore to industries and services in the same period. The rapid growth in mutual fund assets, with the total assets under management of rupees 66.9 lakh crores in 2024, further underlines the deepening participation in India's financial markets. At NSE, we are equally focused on fostering an inclusive investor ecosystem. As of January 2025, our unique investor base has crossed 11 crore 110 million, with the total number of UCC accounts at 21 crores or 210 million. Individual investors now hold 18.2% of NSE-listed companies. Individual ownership in Indian equities has increased tenfold from rupees 7.9 lakh crores in March 2014 to rupees 79.6 lakh crores in December 2024. More importantly, younger investors are playing an increasingly bigger role, with median investor age dropping to 32 from 38 in the last 5 years. The gender gap is also narrowing, with female investors now comprising 24.1% of the total investor base. Increasing investor participation and strong returns generated by Indian equity markets have resulted in a significant wealth creation for Indian households. Our estimates point an accretion of nearly 30 lakh crore to household wealth in the last 3 years, 2022 to 2024. Today, 1 in every 5 households have exposure to equities, up from just 1 in 14 households 5 years back. These developments highlight not just opportunities, but also the need for strong investor protection and transparency. At NSE, we have placed a strong emphasis on ensuring that trust and transparency remain cornerstones of our financial ecosystem. A series of regulatory measures have been introduced, such as the implementation of T+1 settlement cycle, reduction in mutual fund redemption timelines to T+2, and the ASBA, or application supported by blocked amount process, which allows investors to keep their funds in their bank accounts while participating in an IPO. Segregation and monitoring of client funds, upstreaming of funds, and many more. Additionally, SEBI has recently introduced critical regulatory changes to protect investors in the derivative segment. Our commitment to investor protection extends beyond regulations. Investor Protection Fund at NSE currently stands at rupees 2,355 crores as of December 2024, which compensates investors in cases where defaulters' assets are insufficient. Further, the Core Settlement Guarantee Fund, with a corpus of rupees 11,674 crores as of December 2024, ensures timely settlement of trades even in the event of default by a trading member. These initiatives underline our commitment to safeguarding investor interests. At the same time, we acknowledge that the future of the exchange business is closely linked to how we adapt the evolving market demands and technological disruptions. The shift to digital platforms, the rise of algorithmic trading, and the increased focus on global integration are transforming the landscape of exchanges. To navigate these changes successfully, it is imperative that industry and academia come together and foster a deeper collaboration that would help us drive innovation, address challenges, and shape a financial ecosystem that promotes sustainable growth. Before I conclude, I'd like to thank the participants who have come to witness the insightful discussions lined up for this conference. I sincerely hope that our discussions will be thought-provoking, enriching, and will lay the foundation for advancing knowledge and fostering innovative solutions in the fields of banking, finance, and macroeconomics. Once again, I welcome all of you to this exciting conference. Thank you.
Thank you, Sriram sir. I now request Professor Debashis Chatterjee, Director of IIM Kozhikode, to deliver the keynote address and set the stage for today's conference.
Thank you. Deputy Governor Rajeshwar Rao, Ms. Ashish Chauhan sitting there, Sriram, Krishnan, Tirthankar, Ji, who's the chief economist, and very distinguished members from the fraternity of banking and finance, and students filling up a lot of this space. Mr. Rao traveled a year and a half ago to my campus, and we were just talking about why Kozhikode has remained the same. I said some parts of India should remain the same to give you an advantage of what India was like and to be able to reflect on what our past was all about. My heartfelt thanks to Professor Midul Sagar, who's the reason why we are here together. Mr. Sagar heads a center called Uruppika, which is IIM Kozhikode's unique offering as a synthesis of academic and institutional knowledge and enterprise. I'm not an expert. I'm an academic. I coach leaders and I invest in minds, not in stocks. So I can reflect a little bit about the human mind and its enormous idiosyncrasies. First and foremost, we start with two questions, and the questions that are uppermost in our minds are, would the financial system live up to the speed and scope of technological disruptions? That's question number one. Question number two is, can finance be democratized to include large parts of India who are not in the ambit of financial prosperity? And so the answer to the first question is that we rarely recognize that we have entered the economy of attention. We are no longer in the economy of information. We continue to believe we are in there, but we are not. In the economy of attention, a Trump speech can put the market on a tumble. A Clinton scandal can get the Sensex going down. But the point is, this economy of attention is not accessible to everybody. We live in one corner of our vast consciousness, collective consciousness, sitting in the stock exchange or sitting in the academic closets, and we speculate. And we speculate based on data, half-baked information. And the result is, we are always subject to the vicissitudes of the market. But if you look at what the market itself is, market is a mechanism. Market sorts out the efficient from the inefficient. Market does not decide what is good or bad. And to depend on the transactions of the market to speculate about what is going to happen in the financial world is to take the tail of the dog and hoping that it will wag the dog. It doesn't happen that way. What moves the markets are liquidity. And the word liquidity has a great connect between wisdom and wealth. We are looking at two very disparate dimensions of life, Lakshmi and Saraswati. But wisdom and wealth have one common frontier, which is the invisible dimension. Sometimes you call it investor confidence, so liquidity translates for me as investor confidence. which translates as economic growth, which translates as buying and selling in the market. But if you don't have the investor confidence, just observing transactions will not give you much of a clue. So where do you start? We are starting at wisdom beyond the market. In the academic space, we look at wisdom beyond the market, wisdom that tells Chanakya that taxes should be collected by the government in such a way as a bee collects honey from a flower without hurting the flower of the market. So taxation has a way of working in the larger market space where confidence brews. And so my theme, which is the leadership in the financial world, leadership is a forte of the academic world in some sense because we deal with them all the time, and I define leadership in terms of capacity to change. This capacity to change is determined by what Joseph Schumpeter called creative destruction. You can see creative destruction has three components. One is you do not become idiotically consistent with the past. When technology changes the way it is changing, if you continue to harp on past trends, you're going to be beautifully prepared for a world that does not exist anymore. And so digital transformation that is enhancing customer experience, that is enhancing the operational efficiencies of the institutions are not going to remain static. They're going to change dramatically. Just to bring to your point, the very birth of National Stock Exchange started with a person who was reporting to me in my first job in New India Assurance Company. He was a senior assistant, and he used to come to office at 11 o'clock with a copy of the Economic Times and his lunchbox. And he would vanish at about 11 o'clock with the copy of the Economic Times, come back for lunch, and then again go to wherever he was going to at 3 o'clock. He would not be visible after that. So my boss, his boss's boss told me, where does he go? I said, he goes and plays in the stock market. So he said, why didn't you transfer him to Mahalakshmi from Churchgate, Flora Fountain, where his office was? When he was transferred, he looked at the transfer order like a claim that was false, and he put it away, and within 7 days he resigned. After 3-4 years, he emerged as Harshad Mehta, the big bull of India. He was reporting to me. The stock exchange was born out of that inconsistency. NSE was born out of Harshad Mehta's scandal. So you can recognize that a bad turn is not so bad after all, because it is preparing you to deal with those inconsistencies of the past. The second aspect of leadership is the path of a leader is different from the path of an achiever. How is that so? When J.R.D. Tata says money is like manure, it stings when you pile it, it grows when you spread it. He's talking about the path of the leader. Path of the achiever is to achieve, to make money. Path of the leader is to create wealth. This is what Dhirubhai Ambani did when he said, I have to create a phone call as cheap as one postcard. He was talking about the path of the leader. Achiever's journey is not necessarily a leader's journey. You know, I was interviewed for a job by one of the co-founders of Infosys, and he was interviewing me in a small hotel called Lytton. I said, Infosys' co-founder staying in a Category C hotel in Calcutta interviewing me, but I did not know that there was this invisible wealth which was hidden away, tucked away somewhere, which is not visible on the surface. The third and the last element is leadership is about creating trust. It is trust that mobilizes energy. There used to be a time in our days when it used to be said, Juta hai to Bata ka, Naukri hai to Tata ka. Not that I'm advertising Bata or Tata, but I'm simply saying this trust is entrenched in the human psyche in very simple, memorable lines. And we have a way of reducing the complexity of the market into these one-line slogans, which is trust. And I hope NSE, the tremendous work that it is doing under the leadership of Mr. Chauhan, is able to generate trust in our entrepreneurial spirit, in the energy and creativity of the Indian entrepreneur, so that our wealth does not stay stuck in one place and it gets democratized in the true sense of the word. Thank you for your attention.
Thank you, sir, for the thought-provoking address and the kind words. I now request our chief guest for today, Shri M. Rajeshwar Rao, Deputy Governor of the Reserve Bank of India, to deliver his inaugural address.
Dr. Debashis Chatterjee, Dr. Mridul Sagar, Mr. Ashish Chauhan, Mr. Krishnan, Mr. Devdat Chand, Rajneesh Karnatak, Mr. Varadarajan, other distinguished guests here, ladies and gentlemen. Good morning, everybody. I would like to thank IIM Kozhikode and the National Stock Exchange for inviting me to deliver this inaugural address at this second conference. The theme for the conference, Finance for Growth Amid Creative Disruptions, captures the essence of the transformation we are witnessing in the financial sector today, not just in India, but globally. Disruptions in finance are not new, but what sets this era apart is the unprecedented pace and scale of change, fueled by digitalization, artificial intelligence, and the resulting confluence of these changes leading to emergence of new business models. These changes make it essential for us to understand how to harness them for sustainable economic growth. For India, this transformation is particularly significant as we strive towards Viksit Bharat, a vision of a developed and self-reliant economy. Our goal of becoming an advanced economy by 2047 will require us to effectively integrate technology with finance to deepen the markets, expand financial inclusion, and drive economic productivity. Innovation in finance has always been a double-edged sword. On one side, it drives efficiency and inclusion, but on the other, it can destabilize traditional structures if they are not managed well. This is where the distinction between a creative disruption and creative destruction becomes crucial. While both the terms may seem similar, they carry different implications. Creative destruction, as popularized by the economist Schumpeter, refers to the complete dismantling of old systems to make room for new ones. In contrast, creative disruption is a more nuanced process. It's about evolving existing systems, refining them, and making them better through technological innovations. We are not simply looking to replace what exists, but transform what is to the better. This sets the context for my talk today. I would like to share a few thoughts on how digital transformation is reshaping finance, the role of artificial intelligence, the way forward for more meaningful financialization and inclusion, and how the regulatory landscape must evolve to foster responsible growth. The financial sector has undergone a profound transformation in the digital era, reshaping how individuals and businesses access and utilize financial services. The shift from a cash-driven, paper-based transactions to seamless, technology-driven ecosystem has been one of the most defining changes in modern finance. India has exemplified creative disruption in finance through innovations like the Unified Payment Interface, the Account Aggregator Framework, and the recently launched Unified Lending Interface. This has complemented the other components of what is collectively known as the India Stack. In the context of creative disruption referred to earlier, these initiatives have not just supplemented the traditional banking systems, but have also strengthened it by making transactions more seamless, expanding the financial reach, and improving efficiency. Similarly, the rise of digital lending has not rendered conventional credit channels obsolete, but has complemented them, bringing the underserved segments into the financial fold. In my opinion, what truly sets India apart from the global peers is the open approach. Unlike many other countries where these advancements have come as walled gardens, India's financial infrastructure is built on the principle of openness and accessibility. Our platforms are designed as plug-and-play systems, enabling any entity to build on top of it, fostering innovation, competition, and inclusion. Whether it is the UPI, the Account Aggregator Framework, or the Unified Lending Interface, our guiding philosophy remains the same: creating an open ecosystem. UPI stands as a prime example of open digital infrastructure that fosters both innovation and inclusivity. It provides an interoperable framework for instant payments, enabling several private players to build seamless financial solutions on top of it. As on date, there are 39 third-party application providers in the UPI ecosystem, enabling the UPI payments besides the apps of the banks. With over 16 billion transactions processed monthly, UPI demonstrates how public digital infrastructure can empower private sector innovation to promote financial inclusion without the risks of exclusivity. A research article by the World Economic Forum has estimated that UPI has saved the Indian economy approximately $67 billion since its inception in April 2016. While the India Stack has successfully built the digital pipelines that power a seamless and inclusive financial system, as we move forward, I believe artificial intelligence and machine learning will become the engines that drive the next phase of financial transformation. These stand among the most transformative advancements of our times. This growing significance is reflected in how both financial institutions and regulators are increasingly engaged in artificial intelligence related topics. An analysis of the annual reports of the scheduled commercial banks has revealed a sharp rise in reference to the AI and its applications in recent years. Further, this trend is not limited just to the regulated entities. Central banks are also devoting more attention to artificial intelligence in their public interaction. A review of the speeches by the central bank officials globally shows a similar pattern, where the discussions on artificial intelligence related topics have increased significantly, especially post-2022 generative AI wave. This underscores the increasing awareness and strategic focus on AI within the financial ecosystem. While the artificial intelligence adoption in financial services is increasing, it can make a significant impact in three areas: risk assessment and credit scoring, enhancing customer experience, and fraud detection. Traditional credit evaluation relies heavily on structured financial data such as credit history and income statements. However, AI-driven models enable analysis of a vast amounts of alternative data, including traditional transaction patterns, utility bill payments, e-commerce behavior, to cite a few, which can help to assess a borrower's creditworthiness more holistically. This is not only useful in the initial underwriting, but also in proactive monitoring of existing borrowers to detect stress at an early stage and take remedial measures. It also enables offering of hyper-personalized financial products, leading to enhanced customer experience. Another use case gaining prominence, is fraud detection. Unlike traditional rule-based fraud detection systems, which rely on predefined parameters, AI-based techniques continuously learn and evolve, adapting to new fraud techniques and identifying subtle anomalies in transactions and payment behavior. This is especially critical in the era of real-time payments and digital transactions, where cyber threats, frauds, and the use of mule accounts are becoming more sophisticated. On an earlier occasion, I spoke about the risks associated with the artificial intelligence and machine learning models and the guiding principles for their responsible use in finance. Today, however, I want to highlight a fundamental point. While artificial intelligence raises critical issues such as algorithmic bias, fairness, data privacy, and security, the root of these challenges and many others lies in the lack of explainability. Many advanced AI models, particularly the deep learning systems, function as black boxes, producing outputs that even their developers struggle to interpret. In a sector where trust, accountability, and regulatory compliance are paramount, a lack of explainability undermines confidence in the AI-driven decisions. In the absence of explainability, human intervention can end up becoming mere rubber stamping rather than responsible oversight, increasing the likelihood of systemic errors. The second order effects of unexplainable AI is that AI models continuously learn and evolve based on new data. While dynamic adaptation can be beneficial, it also makes the model susceptible to data drift and concept drift. Data drift refers to the phenomena where distribution of data inputs that an ML model is trained in differs from the distribution of data inputs that the model is applied to, while concept drift is an evolution of data that invalidates the data model. These changes can cause models to misalign with the real world trends, risking incorrect financial decisions and instability. Regular human oversight and explainability are critical to prevent such risks. A less appreciated risk of AI-based decision models is the automation complacency, where people rely too much on technology, even when situations need careful judgment. As the aphorism goes, all models are wrong, but some are useful. While algorithms can provide valuable insights and efficiency, they should be used as tools to support, not replace human judgment. A significant yet overlooked barrier to responsible AI adoption in finance is the shortage of professionals who can interpret and oversee AI models. If financial institutions lack personnel with the necessary skills in AI, data science, and regulatory oversight, the explainability problem is further exacerbated, and decisions made by the AI models may remain opaque. Before I delve into the way forward on financial inclusion, another critical distinction is in order. Financialization and financial inclusion are often used interchangeably, but they represent distinct aspects of economic development. Financialization refers to the increasing role of financial markets, institutions, and instruments in an economy. On the other hand, financial inclusion focuses on ensuring that every individual, especially those from the underserved and the marginalized communities, has access to basic financial services like savings accounts, credit insurance, and digital payments. The two are inherently complementary. Without inclusion, financialization risks being concentrated among a privileged few, limiting broader economic participation. Conversely, without financialization, inclusion will remain superficial, as access to banking alone does not empower individuals unless they can also save, invest, and grow their wealth. The Reserve Bank's Financial Inclusion Index, a multidimensional composite index that captures the extent of financial inclusion in the country, stood at 64.2 in March 2024, up from 60.1 in March 2023 and 43.4 in 2017. The index is based on three sub-indices: access, quality, and usage. India has made remarkable strides in expanding financial access with the success of schemes like the PM Jan Dhan Yojana, ensuring that 80% of the adults now have a bank account. Till date, 54.84 crore bank accounts have been opened under the PM Jan Dhan Yojana, with a total balance of Rs 2.45 lakh crores in these accounts. However, true financial inclusion goes beyond merely opening accounts. It requires meaningful engagement with financial services. As the chart which I put in my written speech shows, usage is one which is lagging the other two, and that is something which needs to be addressed. A bank account should serve as an entry point for individuals to access a broader suite of financial products, including credit, insurance, pensions, and investment opportunities. Without this deeper engagement, financial inclusion remains superficial, and the true benefits of a formal financial system do not reach every individual or business. It is encouraging to note that the improvement in the financial inclusion index in 23-24 was largely contributed by the usage dimension, reflecting deepening of financial inclusion. While this shows that we are moving in the right direction, there's still a long way to go, wherein most of the vulnerable populations and low-income groups have access to secure and affordable finance. One of the significant gaps lies in the access to credit, particularly for the informal sector in the economy, which is a major contributor to the economy employing millions. Traditional credit models, which rely heavily on collateral-based lending, fail to accommodate first-time borrowers and small businesses with limited credit histories. As a result, such entities and individuals either remain underfunded or turn to informal sources of credit, often at exorbitant interest rates. Another critical gap is in insurance penetration, which stands at just 3.7% in the financial year 23-24, which is significantly lower than the global average of 7%. Similarly, pension assets in India account for only 21.5% of the GDP, 17% under EPFO and 4.5% under the new pension scheme, which pales in comparison to 80% in the OECD countries, 80% of the GDP in the OECD countries. To bridge these gaps, we must harness the power of digital transformation to make financial services more accessible, efficient, and inclusive. Technology-driven solutions can democratize finance by breaking traditional barriers and bringing a wider range of financial products to the underserved segments of the population. As I highlighted earlier, having a bank account is not very useful if it does not lead to further financialization, that is, ensuring quality and usage. In case of payments, UPI meets all three dimensions of access, quality, and usage. Given the omnipresent nature of UPI for retail payments and its ease of usage, it has become essential for many in the informal sector. This has created financial footprints for a large informal economy, which was earlier mostly dealing in cash. Access to these financial products has been enabled for the financial services providers through the account aggregator frameworks, and it can be employed by lenders to underwrite them using new age models and combining it with alternate data to offer hyper-personalized financial products. This approach is particularly useful in extending credit to new-to-credit individuals, gig workers, and small businesses who may lack formal credit histories but demonstrate strong financial discipline through alternative indicators. Thus, the account aggregator framework acts as a bridge allowing banks, NBFCs, and other financial service providers to access a more holistic and accurate picture of a customer's financial profile. Further, increasing the formalization of MSMEs through the GST, the e-commerce sales data, etc., can help the lenders assess creditworthiness more accurately. To augment the data-driven financial inclusion, Reserve Bank has also facilitated the setting up of a unified lending interface as a digital public infrastructure in the lending space, which will unlock critical financial, non-financial, and alternate data for lenders to enable informed credit decisions. As of December 6, 2024, over 6 lakh loans amounting to rupees 27,000 crores, including 1.6 lakh loans amounting to rupees 14,500 crores to MSMEs, have been dispersed using the ULI platform. 36 lenders, including various banks and NBFCs, have been onboarded. These lenders are using more than 50 data service providers, including authentication and verification services, land record data from 6 states, satellite services, data transliteration and property search services, diary and milk pouring data, and identity and document verification. While technology and digital innovations are driving financial inclusion and access, they also bring with them the risk of excessive exposure and over-leveraging, which can create significant vulnerabilities for both individuals and to the broader financial system. However, as it said, the presence of too much light can also lead to blindness. We must be aware of the risk of reckless financialization. Of late, we have seen some concerns of excessive borrowing in unsecured segments and from the derivative euphoria in the capital markets. The temptation of short-term gains can easily overshadow the long-term financial security of individuals. Financial entities have a duty to ensure that the customers fully understand the risks associated with the leveraged products and also of speculative investing. While RBI, along with other financial sector regulators, is taking progressive steps to educate the customers, financial sector entities also need to shoulder part of the responsibility. Absence of financial literacy leads to people to fall prey to unscrupulous players, which erodes the trust of the people in the system. Increased financial literacy will help to increase trust in the sector and its participants, whose benefits will accrue to the entities themselves. While educating customers helps protect them from fraudulent practices, regulation plays a critical role in maintaining stability and preventing systemic failure. Financial services are regulated because their stability is crucial for broader economy. Failures in the financial sector have severe real-world consequences, often requiring costly taxpayer-funded bailouts. The 2008 global financial crisis is a reminder of how lax regulation and excessive risk-taking can lead to widespread economic distress, job losses, and prolonged recessions. The cost of restoring financial stability in such a scenario is often much higher than the cost of preventive regulation. While strong regulation is essential to prevent such crises, determining the optimal level of regulation remains a delicate balance. Too little regulation may increase the systemic risk, while excessive regulation can stifle innovation, limit credit availability, and raise costs. Thus, regulating finance in an era of fast-paced technological innovation is a delicate balancing act. At the same time, regulated entities must develop the necessary capabilities to implement and comply with the evolving regulations. As financial institutions integrate AI, cloud computing, and API-driven finance into their operations, they must invest in robust governance frameworks and risk management protocols to ensure compliance and customer appropriateness. Financial firms cannot afford to view regulation as a barrier to innovation. Rather, compliance itself must become a core component of their digital strategy. A strong internal culture of risk awareness, ethical artificial intelligence usage, and customer-centric innovation will be critical in navigating the evolving financial landscape effectively. Change is the only constant, wrote an ancient Greek philosopher, and yet change can appear daunting, destabilizing, and even threatening. So will the technological changes lead to creative destruction and really replace the traditional financial institutions like the banks? The specter of the banks being dead. This has been raised in the past also. A quarter of a century back, the issue was examined in the light of disruptive financial innovations of those times, such as securitization, which was touted as evidence enough for erasing the need of banks as financial intermediaries. As the passage of time has shown, these predictions have proved false, and the banking sector emerged even more resilient from these disruptions. Although history does not repeat itself, the potential of the current wave of disruption is arguably bigger. It may be prudent to be cautious while making predictions about a future of banking. For banks and NBFCs, however, the message is clear: adapt or risk being made obsolete. To remain competitive, the financial institutions must invest in digital infrastructure and pivot to a customer-centric, data-driven approach in this new landscape. At the same time, institutions must navigate the risks of excessive reliance on third-party technology providers, ensuring that regulatory compliance and cybersecurity, while ensuring that customer protection remains their top priority. The challenge is ensuring a balanced and resilient financial ecosystem for the future. The key is to harness the benefits while managing the risks. Thank you very much for a patient hearing. Thank you.
Thank you, sir, for the insightful and very informative address. We would now open the floor for the Q&A. In the interest of time, we'll only be able to take 2 or 3 questions. Professor Mridul Sagar would moderate the session.
I hope it's okay. You'll take 2, 3 questions from the floor. Yeah, please. Open to you. Yeah, please, you can ask. Yeah. Yeah, I'll come to you. Is there a mic?
Hiring specifically in the banking sector. So my question is, with more banks adopting technologies such as artificial intelligence, how do you think this will change the employment scenario within the banking sector itself? Are we looking towards a sort of scenario of technological unemployment, or do we not have to worry about that? And what kind of skills do people within the banking sector, do they have to skill up? Those kind of questions are coming to my mind.
I don't know whether it's audible. It's audible, right? Okay, I think that's a very fair question, I would say. Yes, the risks of artificial intelligence impacting on employment is something which we will have to confront. But I think what will change is the nature of the jobs which are being done, and perhaps In today's era of where the banking services are being disintermediated across various spectrums, the nature of the jobs being done will change. There will be greater demand for the AI scientists or data scientists to do the analysis. There could be demand for better cybersecurity professionals, maybe the network professionals. So those kind of employments may actually rise. That is one. But having said that, within the bank, yes, there will be need to really scale up your skill sets so that you are able to be the man in the middle. As I said, the human has to be in the center of the entire interface. He should be able to explain the logic. He should be able to interact with the customers. Having a call center on a computerized basis with AI will not really help many of the people unless there is a human who can understand the problems with the customer faces. And I think in a country like India, which has a diverse geography and a segment of people, starting from the extremely financially excluded to highly sophisticated investors and multi-billionaires, I think there will be a space for a lot of human interface to address the various segments. So I don't think employment may really come down. And again, as we grow into an advanced economy, the amount of financial services which need to be offered to the economy is going to be very large. So in terms of the expansion of the financial services, I do feel employment will rise, but the nature of employment would change.
Thank you very much.
Thank you. In interest of time, just one last question, because our esteemed guests have kept to time. We must also keep to the time. We have a tight program. He had raised his hands first, so I can maybe next
question.
session.
What are the RBI investment in through AI in preventing mule accounts, which is a problem for, I would say, last 15 plus year, except that mule account hunter.ai started and few advertisement. What are the investment of RBI in that front?
No, RBI has an RBI Innovation Hub where this issue is being dealt. I think Mule Hunter is a app which is being developed by them, which would have quite extensive use for the banking sector as a whole. As I said, the technology behind AI would actually help to address some of the key areas like fraud prevention, maybe detection of money laundering or mule kind of accounts. So those kind of data AI would be helpful, and this kind of app could provide kind of a common factor which can be used across the banking industry. So that would be one area where we are looking at. Thank you.
Okay, with my due apologies, I think we'll sort of close this session here, because we have time limits for each session very strictly following, and my request, I know a lot of people want to interact, so over the tea and the next session we have bank MDs and CEO, the same questions could be probably directed to them also. Thank you.
Thank you, sir. We'll now move on to the felicitation ceremony. I would request our MD and CEO, Shri Ashish Kumar Chauhan, to please come on stage to felicitate our speakers. Could we have the memento for RBI DG Shri Raj? Yes, please. Shri M. Rajeshwar Rao. We have the second memento for Professor Debashis Chatterjee. I'm Kozhikode Director. Thank you so much. As we come to the end of this inaugural session, I request Dr. Tathankar Patnaik to deliver a vote of thanks. So I request Professor Mridul Sagar to felicitate with the IIM Kozhikode mementos. We have mementos from IIM Kozhikode too. Yes. Okay, Dr. Patnaik, over to you.
Thank you, Ashiana. Ladies and gentlemen, as we conclude the inaugural session of the NSE IIM Kozhikode Conference on Macroeconomics, Banking and Finance, it is my privilege to deliver the vote of thanks on behalf of NSE. First and foremost, I would like to express our sincere gratitude to our chief guest, Deputy Governor Shri M. Rajeshwar Rao. Thank you, sir. Your thought-provoking address, which looked at so many dimensions of artificial intelligence, the opportunity, the risks that it entails, has truly set an inspiring tone for all our discussions going forward, sir, motivating us to think ambitiously about the future of capital markets and banking in this era of technology. Thank you, sir. Next, we're grateful to Professor Debashis Chatterjee, Director of IIM Kozhikode, for your insightful keynote address, for giving us the opportunity to host the conference at NSE. I'd like to convey our heartfelt appreciation to the faculty of IIM Kozhikode, particularly Professor Sagar, who's here, my partner in crime, for this collaboration. I'm extremely grateful to the cooperation we received from our colleagues at NSE. Your commitment to excellence and attention to detail have ensured that this event has been done very well. I would like to thank our MD and CEO, Shri Ashish Kumar Chauhan, and our Chief Business Development Officer, Shri Sriram Krishnan, for their support and guidance. I would like to extend thanks to our media guests for their coverage of today's conference. Lastly, but certainly not least, I'd like to express my sincere gratitude to all of you, our participants and attendees for this conference, both here and online. We are thrilled to have over 400 participants here attending the symposium in person and an even greater number joining us virtually. Your involvement truly makes this event special. Let us carry the insights gained from this session into our forthcoming discussions through the day and continue to build on the foundation that we have established today. I hope you find valuable takeaways from this conference. Thank you.
Thank you, Dr. Patnaik. We'll now break for a short tea and coffee. I request all of you to assemble here by 10:45.